Alright guys, March 2nd, it's time to tackle the trade. Let's take a look at what we've got here. Again, we'll start out with the E-Mini S&P futures, probably the simplest way to gauge the overall market performance. And we see that, again, the market is up another day. This long upper shadow on the candle tells us that some supply has come into the market, that we've seen a little bit of a sell-off. And it's slowing down. We can see that the range of the candle has shrunk, the body is smaller, and it's a general warning that we're slowing down. Now, that doesn't mean it's going to turn, but we talked about watching out for the support and resistance zone out here at around 1125-ish, and it's slowing down into that range at 1120. It's slowing down. We just got to watch it, but still cautiously bullish. Now, I'd like to check up on the trading ideas we've talked about, and we are absolutely cooking with Crisco. Let's start out with the CAS trade, and we had originally talked about the bullish retracement. The original trade, if you check the videos, was a buy stop above the candlestick high, a stop loss below the candlestick low, and a sell limit at resistance 1250. Well, it triggered yesterday. Boom. We talked about bringing the stop loss up to break even and leaving the sell limit at 1250. And today, boom, it hit 1250. And look how many people sold. Look at that shadow. That is a nice little trade. If we were to kind of break down the numbers, and let's say we got filled at 1170 above the candlestick high, and we used 100 shares. So we would be into the trade $1,170. And at the target of 1250, we've made an 80-cent gain, which would interpret into an $80 gain. It doesn't sound like a lot, but when you break that down into percentages, that is a 6.8% yield in 2 days. 6.8% yield, and that's on 100 shares. Now, let's take a look at the JAS. This is the Joann Stores, and we had worked on the breakout trade. And the original plan was buy above the candle high out here and stop loss either below the candle low or below the pivot swing lows, previous candles. And a target of, we were talking around between 40 and 42-ish if you check the video. So depending on whether or not you sold with a limit, if you did, here's an idea of how it could be panning out for you. If you got filled above this candlestick high at $38.40 and you picked up 100 shares, the position would require $3,840. Here you are 2 days later. If you had sold at 40, that would be a $1.60 gain, or a 4.16% yield on the money in 2 days, of course, minus commissions. That goes for the CAS trade as well. Now, if you're still in the trade, your stop loss is brought up to break even to the price you paid for it, and you are going to let that ride, and at least you're playing with house money, and there might be upside potential for you still. Now, that long shadow makes you go, okay, there's some supply in there. But the upside potential, we said the top of that channel was somewhere near 42 to 42.50, so you could be hoping for some greater upside gain. So that one's panned out like a champ too. And then yesterday we threw on the trading idea on Royal Gold using a put credit spread. Now that is a fancy trade that involves selling a put for the credit and buying a put for protection. And we had established yesterday's trade would require $347 of margin requirement, and a maximum credit would be received of $152. Well, that stock popped up on the breakout. We talked about the W in the breakout, and it's popped up, and today it closed at 46.86. And this is the actual position showing that at that close, that is about a $50 gain on the day, which again doesn't sound like a lot, but on a single contract, that is a whopping 14% yield in 1 day. Now, if it stays above 45, that will give us a much higher percent yield, which we talked about yesterday. You want to go review that video. Now, this is why you need to learn how to do credit spreads. If you're interested, here's another idea on one for today. and I'm going to crack open a chart of Diamond Offshore Drilling. Now, Diamond Offshore Drilling is a pretty fundamentally sound company. They have recently gone through a pretty solid sell-off, and I've gone ahead and drawn slowing momentum on this. So let me get rid of this crosshairs, and we can see the support pivot here. It dropped into this support pivot. That was a pretty healthy drop. The last drop was not nearly as significant, and now we're actually seeing a higher low. And what we're talking about here is that same W pattern, and we still need to get a little bit of confirmation. We still need to see it, but we're looking for a breakout, and you're either going to look for triggers above here, or I'd probably just go above the candle high myself. Now I'm going to show you 2 points of secondary confirmation. I've already checked the sector, and it looks okay, but I'm going to go ahead and delete those drawings. Okay, and I'm going to show you a secondary indicator called a MACD. It's a moving average convergence divergence indicator. It's one of the most popular indicators out there. And it has gone and shifted from negative to positive on the histogram, and it's given a buy signal here where the blue line crosses the pink line. And that buy signal is going to exist every time you get a slowing momentum type pattern, but it's basically saying, hey, support's coming in. Look at all the volume down here as the bottom is forming. That is, in my opinion, accumulation of institutions and individuals buying that security up down here at the low prices of 87, 85 in anticipation that it's going to run back up towards 100, 105 and out resistance at 110. So that's a pretty solid signal, and I'm going to show you another secondary indicator called a Chaikin money flow. And the Chaikin money flow is measuring the average price. It's measuring a typical price, multiplying it by volume, and our money flow is shifted from negative to positive. So money is not flowing out of this stock. It is in the near term flowing in, which is what is helping cause support. Now, those 2 indicators just give me some secondary confirmation. I still probably need to see one more day of upward movement in price. But here's an idea, and this is why you want to learn options and why you would want to learn how to do credit spreads, which is a very simple strategy once you learn the basics. I'm going to crack open a risk graph on that and show you an idea. Now, this stock is $87, and if you wanted to pick up 100 shares of that, you'd have to lay out $8,700 some odd dollars. Well, that may or may not be an option for you depending on account size. This same trade using a bull put credit spread, and I need to explain the details to you at some other time, would require only $315, and I don't care who you are, you can muster up $315 in your trading account. The maximum yields would be $185, which would be an amazing percent return on that, and I haven't even done the math, but that would be your maximum upside. Now, this is for the month of June, so it's going out to June, and there are 108 days, calendar days, between now and then. In order for you to make the maximum gain, that stock simply needs to stay above support at about 185. And so I built this bull put credit underneath that support zone that is building. Now, if it breaks, there are exit strategies and things that we do to mitigate the downside, because I do not want to lose the 315. Now, that's on a single contract, so that's keeping it pretty small with a nice high upside potential. Let's grab the calculator and just do the math, so if you'll indulge me here. If you were able to pull a $185 gain between now and June off of a $315 asset allocation, that is a 58% return on investment between now and the 3rd Friday in June. Now, that's minus commissions and slippage and anything else that would come into that. And that's guaranteed, not a guarantee. But the potential, you tell me what you're getting in that savings account, in that CD. I saw a billboard today advertising CDs at 1.5% annually. This is a particular position that could yield up to 58% in 108 days. And it is with a nominal amount of risk if you know how to collapse the trade or how to hedge the trade. And that's going to take you some training to get that under your belt. I could shorten that up and take a little bit less money and go for April or so, do smaller contracts. Or I could increase the number of contracts. So what I'm going to do is I'm going to take that out to 5 contracts on each one of those. and let you see the numbers here. That would require you $1,575 worth of capital. That would be your margin requirement for your trading account. And the potential yield would be 9.25. Again, return on investment. Now, Albert Einstein once stated that the most powerful force in the universe is compounding interest. We have shown you a 14% return, a 4.16% return in 2 days, a 6.8% return in 2 days. Here's one with the upside potential of a maximum duration of 108 days and up to and including 58% return on investment, which I wouldn't honestly expect to get all that enchilada, that whole enchilada, but I would be happy, quite frankly, with a 20% return on investment on that, or even 10%. In fact, I've never met a percent return on investment that I didn't like. Of course, there is risk involved, and these examples are for educational purposes only, but it's time for you to consider learning how to trade, and particularly learn how to trade options so that you can do these types of things and start to grow your money. Thanks. Have a great day. We'll see you next week.